Mr. Praveen Jaipuriar, the Group CEO at CCL Products, joins us now. Hi, good morning. Thank you so much for making time and speaking with us. Well, what's the impact of the declining coffee exports from Uganda? Because we understand there are drier than normal conditions in Brazil as well. Could you talk to us about how would this impact the crop yield across the world and what would it do to the pricing?
It's very early days to kind of predict the pricing as of now. In fact, there has been a little bit of a softening of prices since the, since the high points 4 months ago. We are seeing a 10%, 5 to 10% drop in prices. What happens is that it really depends on, what kind of crops that happen in the larger, coffee producing countries, which is Brazil, Vietnam and Indonesia. So these are the countries which would drive the pricing trends. The Vietnamese crop comes in late December and January. So we'll have to just wait and watch till January that what kind of pricing trends happen there. And then the Brazil crop is slated to happen in July and August. So in fact, that's the time when the trends will start firming up and we'll be able to predict that what way the prices will go. But as of now, we are not seeing much of an impact in terms of Ugandan, effect on prices. We are seeing a little, softening of prices, and let us see how the crop comes up, and then we'll be able to predict better how this trend will hold up.
I think it's a bit difficult to call at the moment, Praveen, but could you talk to us about how the export outlook is looking for CCL Products itself in terms of the new tie-ups that you have done? What's your own target for, let's say, calendar year 2023?
As we have been speaking, our order positions are very robust, very strong. We have been able to drive our competitive advantage. We've got not only with our existing clients, but also kind of able to penetrate newer clients. And that is why we have been given a guidance that in the short and the medium term, as far as volume growths are concerned, you'll be closer to 20% or so. The value, of course, will be driven by the coffee prices, and so that's the outlook we are continuing to maintain. We are seeing good order positions going forward. So that's the guidance for next year as well.
Praveen, what about your volume growth? Because that over the past few quarters has been quite steady. Do you think that it's sustainable, this 25 to 25% over the next 3 to 4 quarters?
Yeah, it should be. We should be close to that. We are working hard to drive towards that number, and that's the reason we have taken up expansion exercises across categories, and that's the reason we have got this confidence to go for expansion, that we will be able to maintain these kind of volume growths.
When it comes to your capacity expansion as well, you're almost doubling your existing capacity. Can you walk us through, what is the outlook on your aggressive capacity expansion plans?
Yeah, so we just commissioning maybe in another 10 to 15 days our Vietnam capacity, which is going to more than double. So from 13,500 metric tons, we are going to 30,000, which is almost an addition of another 16,000 metric tons there. We have already announced an expansion of a greenfield project in India near our existing Tirupati plant, which will be another 16,000 tons of spray dried capacity. So these are the two immediate, expansions that we are going to take, which are undertake. So, given the fact that Vietnam will be on board next month or so, so another 16,000 gets added right away. And in another year's time, or let's say 16 months time, we will add the India capacity as well. So that will mean that at that point of time, we would have doubled the capacity from where we are right now. And so that was the plan. We have been giving a guidance that over a period of next 4 years, we are likely to double our business if we are going to continue our growth momentum of around 18 to 20% volume growth in the long term. So that is why we have to double our capacity to meet that kind of sales demand.
Okay, also wanted to get a take as far as the domestic business is concerned, specifically with your B2C business, because I remember you had announced a demerger as well with respect to your marketing and distribution business. What's the expectation with respect to how the market share can trend when it comes to the domestic branded business?
So we have had a good run in the domestic B2C segment. segment. We primarily have been a B2B company, and B2C was a new foray for us, and that is why we had created a separate entity for the sales and distribution of the B2C, which is our own brands. And now that we have seen 3 to 4 years pass by, and we have got a decent sense of our trajectory from going from here. We already, in India, where we had launched as the number three coffee brand in the region, which has given us the confidence that we can now scale it up. So to scale it up, we needed more efficiencies and operational efficiencies to come in, and that is why we took this step of demerger, so that anyways the brand belonged to the parent company, and the subsidiary was only doing the sales and distribution. So for that expansion, for the ability to make it more profitable and invest more money behind the whole endeavor, we thought that demerger will be the best opportunity. And we look to maintain this growth momentum of 25-30% over next 3-4 years. So that's our plan, and that's the reason we took this step of demerger, so that we could efficiently invest behind the brands.
Could you help us understand what's the margin differential, let's say in a B2B business versus B2C business? And in context of that, what would it do to your blended margins? Because your margins have been coming off from the levels of around 25% all the way down to 20%. Where is it headed from here on with the increased exposure coming in from B2C?
So, margins won't first, let me tell you, margins won't change, because anyway at a consolidated level, everything got consolidated. So margins were anywhere, built into that. So that's one. So it won't affect the margins of the company. Second, when you are saying that the margins have come down from 25 to 20, it is actually it's an optical way of looking at it. So what happens is that, see, if you see our results this year, while our volume growth has been 20 to 25%, the value growth has been 50%, which means we have got an upside of almost 30% or so, because of the higher coffee prices. So as a percentage to sales, the EBITDA margin looks like it has come down, but that's not the case. If you look at from a volume perspective, we always maintain that the kind of volume growth we'll get will maintain the EBITDA growth. So if you're getting a volume growth of 20%, we are getting an EBITDA growth of also 20%. So which means that the let's say the EBITDA per ton or EBITDA per kg, which is our matrix that we closely monitor, that remains intact. So it's actually only at an optical level you're looking at decreased margin, which is not the case. So if the coffee prices were to come down, what will happen is that these margins will again go back to 25%. So that's the thing that happens.
No, fair, Praveen. I understand that point. So let's talk about the EBITDA per ton, which you said is the more important metric. Where is that headed? Because how should one look at the operational leverage come into the picture once your capacities go up? I'm expecting there needs to be some sort of operational leverage, right? How should I build that into your numbers then?
So, what we are saying is that going forward next to 2 to 3 years, we will maintain the EBITDA per ton at the current levels, because there are 3-4 things that will come into play when, as far as EBITDA is concerned. While there is operational efficiencies getting built up, if you see both the expansions, 16,000 tons at Vietnam and 16,000 tons in India, are in the spray dried category. So spray dried earns a little lesser than the freeze dried. So what will happen is that in the next 2-3 years, the spray dried component will increase. So which means that your margins will get a little constrained there, but that will get made up by the fact that we are doing more volumes, which means that I'll get operational efficiencies there. So they all will kind of balance each other out, and therefore net what we are saying is that we'll maintain this EBITDA per kg for the next 2 to 3 years in the medium term.
All right. Good to have you on board. Thanks very much for giving us that clarity on your overall margins, your volume, looking at doubling capacity in order to meet the strong sales demand, and EBITDA per ton, according to CCL, will be maintained at these levels for the next 2 to 3 years.